The entire idea of investing in property is to generate wealth. It's not about saving tax. If you are buying a property with the sole purpose of saving tax, then you might be in trouble. But the main aim of the property investment strategy as such has to be generating wealth.
Yeah.
And if I'm buying in a brand new property in a new area where hundreds of homes are being built, it will take a long time for the property prices to appreciate, getting rentals, and then with everybody chasing these newer properties, there is a question whether the quality would remain the same.
Welcome to another episode of Building Generational Wealth with Strategic Property Investment. I'm your co-host, George Churchin. With me today, of course, is my co-host, Sandeep Jagtap. Sandeep, good to see you again.
Good to see you, George, and excited to discuss with you after the budget and after our previous episode on what has changed and what's not, how to move on from here and how to move forward. So looking forward to discussing with you, George.
Excellent. So a couple of our last chats have very much been around unpacking the fallout of the budget, right? So to quickly recap, there have been changes to, of course, negative gearing and the fact that, negative gearing isn't dead despite some of the messaging. However, a lot of how negative gearing is treated has changed.
The change in treatment to negative gearing, it's sort of changed a bit, not dead.
Not dead, exactly. And then we're now seeing negative gearing benefits applied to new build properties only, whereas that wasn't the case historically. And of course, there's a change to how capital gains is calculated, moving away from the 50% discount to the indexation model from 2028.
And the commercial property as well, George.
Yes.
So the commercial property still will have all those benefits.
Benefits as well. That's right. So that was a carve out, I believe, after the initial announcements, if I'm not mistaken. And then shortly after that, we saw a change, of course, which we recently unpacked regarding the self-managed super funds and the fact that there are changes to limited recourse borrowing arrangements. Well, ultimately, you can't borrow to purchase anymore as far as residential property goes in your self-managed super fund. So a lot's changed. We've taken some time. We've tried to digest what that means. We've gone out, we've had conversations. And today, I guess, our conversation is very much going to focus on where to from here. So what types of strategies, the discussions we've been having, both from our respective vantage points.
Yes. And before we go any further, George, a disclaimer for our audience. Whatever we discuss here is not financial advice.
Yes.
Please consult your financial planner, accountant, and other professionals and discuss your situation with them before you make a decision about investing.
Yes.
So let's get started, George. You're right. When you summarized our previous couple of episodes after the budget and how we have taken our time to digest what's happening and how property investing is changed. To me, property investing is not dead. A little bit of change, of course, as we mentioned in the last episode, it's just a diversion.
Yes.
But we have to get where we have to get.
I agree completely. And those are a lot of the discussions I've been having, especially with some of the more sophisticated investors. It's an understanding that the rules of the game have changed and, the way that we react to that change also needs to change. Yeah.
And so, George, there are two things the government mentioned in their budget. The brand new builds will still have the same negative gearing treatment.
Yes.
But the question that I get is, if I was to buy a property today, which is a brand new home and land package, I buy it as a brand new. I get all the gearing benefits and all for it. But 5 years later, when I have to sell it to you, for you, it's not a brand new property anymore.
No.
That's why the shine will be lost in that. So it's I don't know how thoughtful this policy or this approach is. And it's only going to change a few things when it comes to new build. The quality.
Yes.
The costs will go up there.
Yes.
Right?
Yeah, of course I will. Yes.
And a lot of time or a lot of energy will be spent in acquiring the property where, you get inexpensive.
I think so. So when you look at it, there's obviously the cost of the land, right? So from the developer perspective, who does the subdivision, brings in the services, etc. And there's approvals, of course, civil work, etc. So that's not a cheap exercise. So there's a cost to be recovered there. And then you've got the smaller developers who come in once everything is subdivided, who might take up a few blocks or a few thousand square meters, and they put up the new house and land. And then there's a cost, of course, to that. So you're really, you need to enter that sort of acquisition understanding you're paying a premium. You're not going to get that at a bit of a discount, no matter how the marketing may have that wrapped. So, and going back a step as well, I guess the entire sort of intention of the government for allowing you to continue to negative gear is to essentially get investors to try and shift tact and contribute to supply. So ultimately what you're doing is you're being rewarded when you do contribute to that supply. So going and buying a house and land package in an area that's yet to be established or recently established essentially creates more rentals, yes. But then, looking at it and saying, me as the investor, what's in it for me? You really need to be careful.
And the entire idea of investing in property is to generate wealth. It's
Yes.
not about saving tax. If you are buying a property with the sole purpose of saving tax, then you might be in trouble. But the main aim of the property investment strategy as such has to be generating wealth.
Yeah.
And if I'm buying in a brand new property in a new area where hundreds of homes are being built, that's where I think it will take a long time for the property prices to appreciate, getting rentals, and then with everybody chasing these newer properties, there is a question whether the quality would remain the same.
That's right. Because when you look at it, even when you're building a standard home, right, the cost of building is quite expensive.
Yes.
And there are times where, whether for clients or personally, we explore small projects, duplex builds, etc. So there's no return. The cost of construction is quite high. The cost of the land is quite high. So then you look at it and you think, well, if I'm buying at the top, where's that room for growth? Because typically we rely on growth to sort of help bring capital into the portfolio. We rely on rental returns to help service the debt against the property. However, if you're buying at a premium and almost sort of you're going to have fairly sort of flat growth for a number of years, you sort of need to understand what you're walking into. And I'm not saying it's all that bad, but you need to enter going, I might not realize any growth for 2 or 3 years.
Yeah.
And be okay with it.
And then another question is, when you buy these brand new home and land packages where the land registration takes a little bit of time, then the plans getting approved, and then the construction. By the time you have the end product, it's a lot of time lost, year, 2 years, maybe 3 years sometimes. And when the land settles, still you get the end product in your hands. You are paying the interest on the
Yes,
land portion and progressive payments on the construction
of course.
before you really start getting a tenant in and getting rent on that. And then you bought it at a futuristic price. So then you wait for another 2-3 years before you start seeing the growth really.
Some benefit. Yeah. So it's, for me, it's about,
So if somebody is buying that to get the negative gearing, they have lost the capital growth in the first 2-3 years.
that's right. So it kind of becomes much of a muchness, right? So, and again, it's really understanding for me what's right for you, because I have spoken to investors who have already decided, and you can't convince them otherwise, that they're going to pivot into that strategy. And it's not all bad. So typically when we sort of talk about house and land, we talk about regional areas, etc. However, if one is savvy enough to purchase something in metropolitan Sydney, understand the planning codes, development controls, understand how to get an approval fairly quickly, and you can turn one standing house into a triplex or townhouses, you're still contributing to supply. So some of those benefits would be there, but that's of course quite sophisticated.
Yeah. And that's not for everyone, like
No.
mom and dad investors. Like the other thing which is exempted from this is the commercial property.
Yes.
And I have seen a few inquiries where people are saying, hey, I want to buy a commercial property. And I'm just sort of thinking, a mom and dad investor who hasn't got that experience of a sophisticated investor as such, just because government has left that out
Yes.
of a certain sort of tax treatment, is that the asset class to go into? Is it for me as
Yeah.
such? It is a great asset class or investment class, but me being a mom and dad investor, is it for me?
Yeah, that's right. I think, again, it's realizing what you're comfortable with. And just because you can do something doesn't mean you should. So it's understanding what you're comfortable with. It's understanding your risk tolerance. The reason I say that is because residential investing, even though I don't subscribe to the fact that it's set and forget, but typically you buy in a blue chip area, you stick to fundamentals over the long term. If you buy well, you do okay. So other than managing things like insurance, interest rates, property managers, some repairs, maintenance, it works. But commercial is not set and forget, not by any means. And I always say to people, you could have two identical assets side by side. One could sell for a very different price to the other, because ultimately, yes, the location and things like that are drivers for growth, but the lease has a lot to do with what a commercial property will sell at. So ultimately, if you and I own buildings, you're on top of yours, they're side by side, mirror image of one another, but I've relaxed, I'm not managing my property manager, don't know when my leases are up, don't know what the market rate is, and we both go to sell, you are going to walk away in a much better position than what I will. So it's about understanding that. It's very much a commercial investment philosophy. And if my investment philosophy is hands-off, it's relaxed, it's passive, it might not be a good fit.
And that is where I think a lot of mom and dad investors or young investors are committing a mistake. They are treating the commercial investment same as the residential investment. They're not.
No, they're not the same. And in our business, Sandeep, as you know, we support commercial acquisition, but we're very, very selective on who we work with. And it's ultimately not so much about the who, it's about the reasons. So if someone has a couple of investment properties, they've got their principal place of residence, and they have capital to deploy, if you've got $1 million, $1.5 million to deploy, then again, a lot of people will rush to commercial to diversify. I tend to ask, what sort of asset do you think you're going to get? And you might get an industrial site. Then I'll ask you, what location are you going to get it in? You might say somewhere regional. And then I'll say to you, if there's a vacancy for 6 months, how are you feeling about that? If your phone doesn't ring, or if your phone doesn't ring for 12 months about a tenant, wanting to rent your space, what's your mental space going to be like? What's your headspace going to be like? It's not going to be good, because ultimately, unfortunately, $1 million doesn't get you very far into that asset class. So unless you've got another way of sustaining those ups and downs, the loss of income, the loss of rent, and you can be okay after 6 to 12 months with no inquiry, it's probably not the space for you. And that's, talking about a really bad example. There are multi-million-dollar investments in blue chip areas in Sydney, Parramatta, Manly, Hills District, wherever, the East, and you see vacancies, but they're owned by sophisticated investors who understand it.
And that is the key consideration in when you acquire a commercial property, George. How long can you hold it if there is no tenancy, or if there is a big gap between the tenancies? How much cash flow do you have to throw at the property while you wait for the next tenancy?
Exactly right. And it's a case of, well, what do I do now? So if you're in an area where there are other commercial spaces, and an industrial lot is a very good example, right? So you might be in a development that has 12, 15, 20 other industrial sheds. Yours is vacant for 6 months, but one that becomes available after you rents before you. So do you just sit there and wait, or are you proactively looking at it going, well, how's my property manager marketing it? Am I priced at a competitive rate? What can I do? What incentive can I offer prospective tenants to come in and take my space? Because again, it's not just a matter of waiting and hoping. It's, well, if no one's coming, how do we make them come?
Yeah. And commercial property would be so great for somebody like yourself, myself, like the professionals who run their own business.
Yes.
Yeah, we may think of running it from our own premises.
Yes.
Principal place of doing business, right? And the classic example would be a doctor.
Yes.
A dentist, right?
Absolutely.
These guys can set up their medical facility to operate from. That's a great investment.
Absolutely. And we do a number of those a year, Sandeep. So it makes sense. They go off, they get their advice from their planners, their accountants. They understand, I guess, the nuances of investing in commercial property through their self-managed super funds. And it makes perfect sense because it's evergreen. Your business is paying the rent for you. You ultimately stand to benefit on both counts.
And that is a beauty for professionals who are operating their own practices.
Yes.
SMSF and commercial investing in SMSF is not dead.
No.
It's still active.
Yeah, I think so. And my personal belief is we're going to see a bit of an uptick in that space once the current sort of floodgates for residential close. And again, market takes a sigh of relief. So if you are a business owner, you're property centric, and you're looking at it saying, geez, the rules around me have changed, but I still want to invest in property, it kind of becomes an obvious choice.
Yeah. And that's where I think commercial property needs to be treated a bit differently than residential property is what we both agree, I believe on.
100%.
It's not for everyone, is my first point. It's not for everyone. One needs to really have a good cash flow and
Yes.
good cash reserves to make sure they can sustain the period of extensive vacancies.
Mhm.
And another thing is transaction. When you sell in commercial property can be a difficult one or a longer one.
Yeah.
It's not as easy as selling a house on auction with
Not
4-week
at all.
campaign.
Not at all. And the due diligence involved is very, very different, right? So, especially right now, we're in an age of a lot of information, a lot of podcasts, a lot of large language model AI tools where people have information at their fingertips, right? So, the due diligence for a residential property, I guess, once your offer is accepted, is building and pest inspection, finances. You inspect the property, make sure you look at flood zones and other things. However, in commercial, the building and pest inspection is, again, very different depending on the type of asset. Then you sort of start to look at the financial position of the tenant, right? So ultimately, the strength of the property and the value of the investment lies in the lease, and that's very much dependent on the strength of the tenant. So if it's all well and good having a 3-year or a 5-year lease with a 5-year option and a built-in escalation, but if your tenant is on shaky ground, then it's red flags from the very beginning. So the due diligence is very different.
So would it be fair to say, George, say for example, I'm your client, I've got my principal place of residence and one investment property. And because I've heard from friends, I've done some chat GPT research.
Mm-hmm.
I come to you and say, George, let's go commercial. Not for someone like that, right? Not for someone like that, because there's so many things to consider.
There's a lot to consider, absolutely. And I'd probably sort of start with casually asking you a few questions. So, what makes you want to go into commercial property for a start? Well, I had my friends do it. They've all invested in commercial. So how hands-on are you with your current investment? And if I said to you, you have to carve out, 5 or 10 hours a week or a fortnight to make sure that your commercial investment is sound, can you afford that time? And then
the cash reserves.
Do you have the cash reserves? So can you sustain a 3-month vacancy if no one rings to take out the space? Are you comfortable with that for 3 months? Or does it make you very uncomfortable? And, there are knock-on effects with this. So people tend to stay awake. They tend to stress. So, unless your answer is, well, that's fine, then, you really have to question whether it's right for you.
And that's where I think, George, to summarize, the commercial property aspect is a great investment if you are going to do it through super.
Yes.
Because it's a long-term game, and super fund will still be able to borrow to invest in commercial property. If it is through super for your own business activity,
Yes.
even better. Without being in super, you can still invest in. If you have to operate your business out of that, that's another great opportunity. Yes. But just because there are certain government initiatives and something has stopped one going into this direction would not be a great strategy.
No, not at all. And I'd sort of tend to want to unpack what strategies one has explored in the residential space before actually shifting, because it's one thing having a portfolio, but it's another thing extracting as much value out of your existing portfolio to begin with, right? So you go from something that's really low risk, but medium level of reward, to something that's high risk, high reward. But there's a middle ground. So have you done strategic renovations on your residential space? Have you looked at extracting a second avenue for income from a particular property? Have you had periods of vacancy with no rent? Major issues, renovations. Has the roof caved in? And all of these things sound trivial, but it goes to sort of explain and illustrate one's tolerance for risk and one's tolerance for pressure. So if you've been through all those things and you've had your roof cave in, but you haven't handled it well, it tells me on the commercial side, when things go bad, then you may not handle that so well as well.
Yeah. So George, brings me back to the same thing again, and that is established real estate.
Yes.
But before we go there, one other strategy which I've seen a lot of clients doing is they have a principal place of residence which was bought before the budget night.
Yes.
Upgrading that, making that as an investment property, and upgrading their home and buying another property which they would live in and then invest this property, that's still that last sort of negative gearing opportunity that people have.
Yeah.
The accountants and all would probably tell whether it's the right strategy or not, how the NTO looks at it or not. But yeah, people probably upgrade their principal place of residence, and rather than selling this property, make this an investment property. Still not a bad option. Still another option to do it.
Agreed. A lot of the conversations I'm having at the moment, we tend to be coming in earlier into the piece, Sandeep, just even before the acquisition, the physical search starts. And it's around strategy. So with a number of people, we are talking about upgrading your principal place of residence as a strategy. Because as you said, if you've held it prior to the budget night, and chances are if you've held it for 10 to 15 years, you've seen a tremendous amount of appreciation, a tremendous amount of equity that has been built up, especially since the COVID run. So you look at that and you say, well, if there's not a lot of debt against the property, there's a lot of equity, you're not going to invest in residential in the traditional means, then you look at upgrading your principal place of residence. So what that ultimately does is it keeps a blue chip asset in your portfolio, which might grow at 6 or 7% year on year. If it's already worth 1.5, 2 million, a rate of 7% per year is not bad. And then you look at upgrading to a new home. So it consolidates your wealth, but it's not a bad strategy at all. And people are considering it.
Yeah. So it comes back to that same old question, established property.
Yes.
So if I ask you new builds versus established property, what gets a tick?
For me personally, always established property, because there's a level of uncertainty with new builds. And as we said at the start, you're buying at a premium. So I can't improve a new build, but I can improve upon an established property.
Yep. And with the established property, they come into well-established areas, which has got all the infrastructure in place.
Yes, exactly right. It's got the fundamentals, right? So whereas if you're buying something that's house and land, and if it's a little bit remote, it's not going to have metro or rail connectivity, at least not for a number of years. It might not have, the TAFEs, the hospitals,
the supermarkets,
universities, the supermarkets. Exactly right. So I think for me personally, I've probably got a bit of a bias, but I'd be almost exclusively leaning towards established properties, because again, it's got all the fundamentals from day one. And you know that if I need to exit, even in an emergency earlier than planned, you know that there's going to be a buyer for it.
Yeah. And the other thing which I love about established property is you get decent amount of a land parcel.
Yes.
With the established property. Yeah, the property might be a bit old. It may need maintenance every now and then. But then you get a big asset on a better piece of land rather than the brand new build, which is probably 300, 350 square meters. We all even seen a 200 square meter.
I have seen several. Exactly right. And that's the thing, right? So for us, something that's baked into a lot of our strategy is we want to give clients options. So, and even in my own investing, our own investing. So we want options, and it doesn't mean you need to pull the trigger every time, but it's nice to have an option when you need one. So what I mean by that is if, let's say, I've maximized or close to maximized my borrowing capacity, but there's enough there for me to, I don't know, put a granny flat into a property somewhere in the Hills District, and I can start drawing an income. That's something. Whereas, and of course, I need to have the land, right, to your point. So if I've bought there 500, 600 square meters, there's room for it, it's well positioned, I've future-proofed my decision making, great. But if I'm buying a 250 or a 300 square meter lot, and I get buying a home, of course, is better than not buying a home. But from an investment standpoint, there's not much I could do to improve a brand new home on a 250 square meter lot.
And I've seen a few clients who always go in the brand new properties, and they have done well too. So not that this is right or that's wrong.
No.
It is about what will generate long-term great amount of wealth through that property investment. So if you ask me what would I buy today, I would definitely buy an established property. I would love to buy a corner block, which has got 2 street access and decent enough size, which I can later on subdivide.
Yes.
And have a second dwelling on that.
It's a great strategy. And if you do that, you might actually get the perks of
the gearing benefits and all. That's just
not the driver, but
that's just the fries on the meal. But it's just the meal as such. I'd probably say is the right parcel.
Yes.
where I would definitely generate wealth over a number of years.
I think so. And to your point, I think I've also known people who have traditionally always gone the brand new, off the plan house and land, and they've done well. But it's, again, understanding, your timeline and your risks as well, because what you hear is about the success stories, but people don't tell you the losses that they take in private, right? And the location as well has a lot to do with it. So a few years ago, house and land package, people were talking about Box Hill, right? And there's still options available, of course, in that regard. But Box Hill is now in part $1 million suburb, or it was until the recent sort of dip.
I've seen Box Hill. I've seen people buying land in Box Hill for 500, 600, and I've now seen properties at 1.7 and 1.8.
Yeah.
And when here we are in Parramatta, and it probably is about 45 minutes away from there.
Yeah.
But I bought an established property, about 60-year-old property, 10 minutes from Parramatta.
Yes.
It's done really well.
Yeah, it will do. It's the proximity, right? It's the fundamentals. So I don't think you could go wrong.
So my next question to you, George, then, after the budgetary changes, after a little bit of drop in the borrowing capacity for a typical investor, how would you approach what sort of, if I were to ask, I was a client coming to you and asking you, George, I'm ready for my next purchase. My broker has given me a budget of, say, anywhere between $700,000 to $900,000.
Mm-hmm.
Which possible state, what sort of areas of that state would probably look attractive to you after all these changes and looking at the next 3 to 5 years?
So with the top end of that budget, I would probably almost certainly look at areas like Moreton Bay, just north of Brisbane. The reason I say that is, firstly, it's proximity to Brisbane. So it's quite diverse. It's kind of like the Central Coast to what the Central Coast is to Sydney. So people are born there, raised there, live there their whole life. You've got all the amenities. You don't really need to leave the region if you wanted to. But if you had to, it's close enough to Brisbane. The closest, I guess, point is about 40 kilometres from Brisbane, which isn't far at all. So from a price point perspective, especially now, so we've seen the $1 million suburbs regress a little bit in that region, which is to be expected. So up to 900K, so 750, 800 to 900K, definitely Moreton Bay, Brisbane. You'd get something that's low set, brick, 4-bedroom, 2-bathroom, 2-car, 500-600 square meters, low maintenance, 12 to 15 years old, good size block. It gives you options going forward and a great return. To give you an idea, you're talking 5-year average growth rates of 15 to 18%.
Wow.
In Moreton Bay, with rental yields of, depending on the suburb, between sort of 3.75 and 4.25%. So,
and with the national rental yield average being 3.5%.
So it's quite a good proposition, right? And then if we were to move around the states in terms of New South Wales, we were looking at places like Tamworth. We're looking at places like, what else? So Orange, parts of like Dubbo, Bathurst, so real regional markets. Top end of that, again, the 900K mark, Central Coast, you'll get into Central Coast, parts of Western Sydney as well.
Southwest.
So albeit your greater Campbelltown region, albeit your...
Some real good opportunities there.
Real good opportunities. Albeit when you sort of put them side by side next to something like Moreton Bay, there's a clear contrast. But again, it's not for every investor. The decision isn't about the numbers. Some might say, look, I live in Sydney and I want to be able to jump in the car, and they can't move on beyond that. So that's fine. So for those people with that sort of approach and requirement, it's a very good proposition. In Victoria, again, it's probably the same markets as what we had a few months ago. Parts of Western Melbourne, in the Wyndham Vale region, Werribee and surrounds. Again, I'm very mindful of what I'm buying in those areas. Ultimately, for one major reason, as we were talking about a few minutes ago, you've got the new part and the old part. So the old part, larger blocks, more options as you become more mature in your investment. New part, 250 carved up blocks, not much you could do, same price point. I know which one I'd be choosing. And then you've got Bendigo, Ballarat, Geelongs of the world. And for me, Victoria is quite good because their planning laws are very liberal compared to New South Wales. So you could do more with less. And then in terms of South Australia, WA, Again, my personal view is those markets have done their running. So we're not actively looking for clients in those markets at this point. I have heard quite a few, and I've seen quite a few white papers touting apartments in Melbourne. I'm personally quite skeptical of that, again, because there's a large level of supply. And then also Northern Territory. So the market cycles in Northern Territory are quite long, where I've had first-hand experience speaking with people who have bought in 7-8 years ago. Have seen no growth over an 8 to 10 year stretch. But now there's a bit of a narrative around investing in NT. I'm just mindful of where that demand is coming from.
Yep. And to target these type of opportunities, George, what we are trying to do with our clients is, if there is this period of uncertainty in the market, use that to your advantage. Use that downtime to restructure yourself, reposition yourself. Look at your entire portfolio at this stage. How is it going?
Yeah.
Are the rentals all good? Is there any works that are coming up? Should I then extract equity and sit on it for the right opportunity to knock? Right?
That's right.
So a lot of our clients, we are doing a lot of housekeeping with them. As we usually do, our retention team always is proactive and reaches out to the clients. But
Yes.
that is our advice to our clients, to get your house in order while this is all playing out, right?
Absolutely. And I think that's a very good advice, because it's something we haven't touched on in quite some time, because, investing isn't always necessarily about acquisition. It's about calibration. So
Sometimes no action is a good action.
yeah, exactly right. And just because you're not buying something doesn't mean you can't look at the efficiency of your portfolio. So to your point, what you're paying for your insurances, your property management, is your rent up to date? Especially in places like Queensland, where there's a anniversary date fixed to your rentals. So it's being mindful of when that is and exercising that option if it's right. And something that you could probably tell me a lot more about is the appetite for lenders in the current climate to review rates. Because if you're on a rate and you can get a 0.25 or a 0.5% variation, that could be huge.
Yeah, and that's what we are proactively doing with our clients. And absolutely, every now and then, one needs to see whether they're in the right space. If
Yes.
not, how can we make it even more efficient? Like if there is a period where the market is not going to do that well, that is the time when I need to restructure things to make sure that I spend a little less
Yes.
to hold those properties.
Yes.
If there is equity available, I'd probably extract it and sit on it. The reason being, for an investor, there will be a next opportunity somewhere down the track.
Yes.
And being ready for it is going to help you negotiate it really well and acquire it really well.
Absolutely. And especially if you can temporarily park it in an offset or something and reduce your interest, right?
Yeah, you don't pay the interest while you haven't deployed the capital as such.
Yes. Yeah.
Right?
Yeah.
It's just that being ready with that and have yourself pre-approved for the next, while you do the equity extract, parallel application to be lodged to see what sort of bank pre-approves you, so that you know what type of opportunity you're looking at. That gives you a good leverage when they go to the like of yourself, the buyer's agents, and say, hey, Mr. Buyer's agent, this is the equity we have. This is what the pre-approval is looking at. And this is what our big plan was. And we have acquired a certain part of it. And now that is probably the next step.
What's
So
left?
that gives you a clear brief
Yes.
of what the client is really looking for as a next acquisition.
100%. 100%. So it's good advice. It's not sitting idle. It's not waiting for the market to sort itself out. It's what can I do in my space to be better prepared.
Be proactive rather than being reactive in this market, right?
100%.
And as you said in the previous episode, is the comeback. Once it all starts, the momentum picks up.
Yes.
You won't get too much time to sort of take your time and acquire. This is the time.
Absolutely, because with confidence comes competition, right? So if I'm in a position to move now and I'm confident, I've got my plan, I'd rather move now, knowing I've beat the crowd, as opposed to trying to be a number in a crowd competing.
And if I was to acquire an asset today, my horizon is 10 to 15 years. And there will definitely be changes in government policy, changes in
Yes.
investing attitude, mentality, and whatnot. And my asset will do well over a period of time.
Exactly.
That's where, as an investor, as a professional, I don't see a reason to be scared or being nervous. One needs to be very thoughtful and really acquire well. the great business in property investing is done while acquiring the property.
Yes.
So that due diligence, getting that professional help, being finance ready. If you ask me, I'm finance ready all the time.
Yes.
Every now and then I'll recalibrate. I'll say, okay, this is the equity I've got. Just park it there.
Yes.
I know what my buying limits are. So when something comes up, like a couple of my properties were not when I planned to buy them,
Okay.
but it was always a part of my longer term strategy and I was ready
Yes.
and something really good came out.
Yep.
And I thought, yep, that's for me.
That's good.
Yeah,
planning.
it has come 3 to 4 months early, but I'm ready for it. Why not take it?
It's good planning. Absolutely. You need to be ready when the opportunity presents itself.
And all those properties over the last 3 to 5 years have given me crazy growth. I know the market was great,
Mhm.
but being ready allowed me to get those opportunities. And that has given me this capital growth that I have.
Absolutely. Because the other version of that story, Sandeep, is you're not ready. You're sitting, you're waiting. And before you know it, the market's moved in a way where you can no longer enter, right?
Mm.
So, and that's a bad position to be in.
And that's where what I don't like about fence sitters, they always miss out.
Yep.
They always listen to the news. Look, there's news, but you need to read through the news.
That's right. I mean, and if, the news is saying something that doesn't apply to me or to, the listener, then you still move forward, I guess, with your plan with a level of caution. So just because if I'm prepared to buy just because they say the market's bad, etc., well, I understand the market. I understand how it works. I understand there'll be a peak and a trough and a bounce back. I know which side of that line I'd rather buy in. Yeah.
So if both of us have to give our audience one tip, given there's so many changes that have happened in the last 2, 3 months, 4 months, if I were to ask you as an investor, I know you've given some real good pointers in that 7 to 900K mark in certain states and all. What would be your advice to stay put, be ready, buy now, wait for the next 2 years? What would probably you be talking to?
So I'd be saying be ready. I'd be saying, like we mentioned earlier, wait until the current stint of SMSF buyers have worked their way through the market.
Which is probably finished
Couple of weeks
now.
away. That's right. Yeah. So then I think by late August, early September, again, the market will recalibrate from the effects of the budget. And now that the SMSF doors are closed, at that point, you'll really get a sense of a layout of the land. And I expect in the short term that investors will not be in the market. The competition won't be there. And that's where you find real opportunity, where there are motivated vendors in the markets you're in. I'd be prepared to act on those at that time.
And likewise, I would probably be saying the same to my investors. Be ready, do the housekeeping, try to get your existing loans in order, see where you can save
Yes.
while renegotiating with the lenders, finding how much equity you got, finding how much your borrowing capacity is left over. How does the current climate affect your long-term wealth generation plan? And if you need to pivot a bit to sort of get in now, or probably position yourself to get in probably in a few months' time.
100%. It's all about the preparation.
All good. George, thanks again for joining me on this episode. I think the last 2 episodes have been really good to sort of calm down the nerves.
Yes.
Like there has been so much uncertainty and so much negativity. I think we've done well to sort of calm down the nerves for the investors, and we got so much. I'm so much excited. I love when the market resets. It gives you opportunities again.
Absolutely. And volatility, a little bit of volatility in the market's quite good because it creates opportunity. And I'm grateful to have had this chance to sit down with you and unpack it all.
Thanks, George. Thanks. And next episode, we'll unpack something else and some real good positive things about property investing going forward. So thank you and see you again to the next one.
Thank you, Sandeep.
Thanks everyone for tuning into this episode. Let's see you again in the next one. Thank you.